A little more than a half an hour to go until the opening bell on Wall Street. We want to talk more about the markets right now with Noah Blackstein, who is senior portfolio manager at Dynamic Funds. Noah, it's been a heck of a start to the year. I think the gains we've seen in the first month of the year have caught people as off guard as maybe the declines did last year. How are you feeling about things overall at this point?
I've been doing this for a long time, Becky. Typically near the end, whether it was in 2002 or even in 2009, the start of a new bull market usually starts off with a significant rally and stuff that was beaten up the most. And that's probably what we're seeing now. This has been really a bear market led by inflation, certainly, but more recently by Fed policy and aggressive rate hikes. And so, we're coming to the end of that. We'll see the damage done to the economy. I think the jobs report should alleviate some concern anyway in the first half of this year that there's a recession coming. But for the most part, it's not something I haven't seen before when things start moving off the bottom, that's for sure.
Well, let's maybe clarify and not gloss over the headline here. You think this is the start of a new bull market?
Well, I think that there's been significant damage done to the underlying market for sure. I think last year was a very, very unique year in terms of, typically when the Fed is raising interest rates, the stock market's going up, not down. But the aggressiveness was quite severe last year. And became a one-way bet for shorts. You just had to stay short the overall market despite strong earnings for companies. And if the market ever rallied, you didn't have to worry because you'd have a speech by a Fed governor or chair that would hopefully talk down the market on your behalf. I think that's sort of coming to an end here. And so, we really had a one-way trade of high correlations and heavy short selling and difficult positioning overall. So, I can't say this market's going to be gangbusters this year to, just annualize the first month and that'll be your annual return. But I do think we'll see wider dispersion and it won't just be a single one-way bet. So I think there are certainly opportunities in 2023. That's for sure. And I do expect it to be an up year.
You think we've seen the lows at this point? And it's at least uphill from here?
I think you haven't seen the lows for some stocks, and you've probably seen the lows for other stocks. I think there's a lot of companies who have had very difficult time since 2021, who people have written off, who may have been pandemic beneficiaries, who have gone over a year and a half, perhaps 2 years, for sure, of difficult times. And I think that those businesses are looking better, just comparisons alone that they're looking better. And if they've retained customers obtained during the pandemic, they certainly have a better runway forward. There are other companies, though, who I think have reacted, as opposed to artificial demand during the pandemic, have reacted to inflation, who are over-earning because they've raised prices significantly and are seeing declining volumes. I think those are probably the Pelotons of 2023, the companies that have just jacked up prices in declining volumes in response to inflation. So I think it's a bifurcated market for sure. But I certainly think that there are a lot of opportunities and probably in different areas than most people think. We'll see what the Fed decides to do, obviously, and if they've chosen to continue to destroy the market, that's their call. They seem to like talking it down last year. But we'll see where things go. Rates have gotten a lot higher, and the economy is certainly slowing. I don't know if demand, there's certainly a pause right now or a certain amount of uncertainty among CEOs and CFOs in terms of planning for 2023. Whether that progresses into a recession, we'll see as this year progresses.